It's a great day at Equity. Today, let's talk about how to plan now to save $5,000 or more. If you purchased a home in the last 2 years, or if you're getting crushed by student loans, you might want to look at itemizing your tax return instead of taking the standard deduction. Are you finishing your extended tax returns that are due in October? Use this information or remember it for January at tax time. It's important to consider, should I itemize or take the standard deduction? During 2020 and 2021, we got used to simply using the standard deduction because mortgage rates were so low. But since then, mortgage rates have risen drastically. In fact, all loan rates have risen drastically. So let's revisit an old trick, itemizing. Before I continue, I need to disclaim that we are not accountants or tax advisors, but want to review basic items, which you can think about and then ask the experts. This is just to increase your knowledge and to get you thinking about it, since you might need documentation. Claiming the standard deduction is quick and easy. No documentation is needed. For 2023, the standard deduction numbers for those under 65 are single taxpayers filing $13,850, married taxpayers filing a joint return $27,700, and head of household filing $20,800. So, why itemize? If you can exceed the numbers above, then you will save paying taxes or possibly get more money in your tax refund from taxes already paid. 3 easy things you can itemize may save $5,000 or $10,000 or more in taxes. I'm sure you can use another $5,000 or $10,000 compared to the IRS. Do you have a mortgage? All your mortgage interest can be itemized. Say you paid $27,871 in interest in 1 year. Maybe you paid a point or $4,000 in your closing cost for your interest rate. That can be itemized. Plus, your real estate taxes are eligible for itemizing. Estimate that at $700 a month. So that is another $8,400 to itemize. Total is $40,271 in just this one itemization. This is much more than a standard deduction. This would save you thousands of dollars depending on your tax bracket. So, how does someone document this? Your servicer will send you a Form 1098 in January or February each year. That is all that is needed. So, just having that knowledge is key. Do you have student loan interest? You can take a tax deduction for the interest paid on student loans that you took out for yourself, your spouse, or your dependents. This benefit applies to all loans used to pay for higher education expenses, not just federal student loans. The maximum deduction is $2,500 a year. How do you document this? The 1098E tax form shows the amount of interest you paid on student loans in a calendar year. Loan servicers send a 1098E to anyone who pays at least $600 in student loan interest. Did you make donations to nonprofits? Dollar for dollar, you can itemize for any donation as long as it's to a nonprofit. How do you document this? Donations under $250, you simply need a copy of your canceled check, receipt, or credit card statement. Donations over $250, you need a written acknowledgement from the charity stating the value. Let's take a look at the Schedule A Form 1040 used to itemize. On the form, you'll see there are many other categories to itemize, but some are more complex than others, so seek advice from a tax professional. Here's a list of additional categories you might be able to itemize and save money. Federally declared disaster areas, hurricane, tornado, and more. Generally, you may deduct casualty and theft losses relating to your home, household items, and vehicles on your federal income tax return if the loss is caused by a federally declared disaster. You may not deduct casualty and theft losses covered by insurance unless you file a timely claim for reimbursement and you reduce the loss by the amount of any reimbursed or expected reimbursement. Alimony payments, money input into a health savings account, gains from the sale of your home, medical and dental expenses over 7.5% of your adjustment gross income, gambling losses, miscellaneous other areas too. The key takeaway is if you purchased a home or refinanced in late 2022, 2023, or this year, stop and review this again. Or, sadly, if you lost money due to a federally declared disaster area, you can find some additional recovery this way. You might be able to save thousands of dollars with minor documentation. As always, consult with a tax advisor. So thank you for joining us. Don't forget to like this video, subscribe to our channel, and turn on your post notifications to never miss a new video. Please leave a comment below if this video was helpful and if you'd like to see more videos on similar topics.